stop what you're doing for a second because the next few days could redraw the map of money, markets, and power in a way most people won't see coming until it's too late. While everybody's arguing about personalities and headlines, something far bigger is happening underneath. A pressure point has formed, and it's sitting right at the intersection of Greenland tariffs and a global scramble for real assets. And here's the part that should make you lean in. The market is already reacting like it believes the world just entered a new phase. Not next year, not someday, right now. Now, before we go any further, quick note. I'm running a campaign to eliminate copycat channels that recycle content and drown out original work. If you value what we do here, support John AG in this fight by subscribing and dropping a comment. Literally anything, even our John AG. That one tiny action helps the algorithm understand you actually want real analysis, not recycled noise. Also, if you want daily updates, quick posts, and my personal takes that I don't always put on YouTube, I created a WhatsApp channel. It includes premium-style posts, instant voice notes, and fast updates when the story changes. The link is in the description. Join it so you don't miss the turns that happen between uploads. Alright, let's get into it because this story isn't just Trump wants Greenland. That's the surface-level version. The deeper version is about control, leverage, and the repricing of risk across the entire planet. Over the weekend, the US president escalated his push to bring Greenland under US control and tied the issue to tariffs on multiple European countries if they resist the deal. The tariff threat starts at 10% on February 1st and ramps toward 25% on June 10th. The instant that message landed, the market did what the market always does when it smells instability. Stocks sold off, treasuries sold off, the dollar weakened, and the so-called boring safe havens didn't look boring at all. Gold pushed to another record level around 4,063 per ounce in the script we're reacting to. And silver ripped past 94, suddenly feeling uncomfortably close to triple digits. Now, I'm not telling you to buy or sell anything in this video. I'm telling you the market is sending a signal, and the signal is this. When power realigns, money moves first. So the question becomes, is this just theatrical chaos or the opening act of a new doctrine? Because if you look at the breadcrumbs, you'll see this wasn't improvised. Months ago, a national security strategy document was released that laid out a new set of priorities. The language basically screamed one message. The US wants primacy close to home, and it wants to block rival powers from owning or controlling strategic assets in the Western Hemisphere. That is not a small shift. That is not policy nuance. That is a line in the sand. And when you combine that with recent actions in Venezuela, you begin to see a pattern. Consolidate influence, regain leverage, and squeeze out competitors where it matters most. Now, here's the twist most people miss. Greenland looks like an ice-covered rock in a remote corner of the world. But in the world that is emerging, where missiles fly over the pole, where shipping lanes open through the Arctic, and where sensors and interception matter, Greenland becomes a strategic chess square. And if you're thinking, okay, but is this really worth all the drama? Stay with me because the drama is the point. The drama is part of the pressure campaign. And that's why this week, with global leaders gathering in Davos, the situation could either calm down or explode into something the market can't ignore. So let's break it down the way investors should. What's the strategic logic? What's the economic logic? And what does this mean for gold, silver, the dollar, and the next leg of market volatility? First, the strategic logic. Greenland sits in a place that matters for early warning, missile trajectories, and the entire concept of layered defense. People have heard talk about a massive defense initiative. Some call it branding, some call it fantasy, some call it necessary. But the core idea is simple. Detect threats earlier, track them better, and intercept them more reliably. Whether you think that's realistic or not, the planning behind it changes behavior. If you're going to invest huge resources into sensors, radars, interceptors, and command systems, you want control, not "we'll ask permission later." Control. Real control. And that's where sovereignty, basic rights, and autonomy become the hidden leverage points. Even without outright ownership, a country can push for long-term control over facilities, corridors, and decision-making. Now, the second layer is the Arctic itself. As ice retreats and routes open, the Arctic becomes less like a frozen boundary and more like a superhighway. That means shipping, submarines, monitoring, and competition. Competition creates spending. Spending creates deficits. Deficits create currency stress. Currency stress is one of the quiet fuels of gold and silver. Now, let's talk about the economic logic because this is where people either get distracted or they get ahead. A lot of folks immediately jump to rare earths and minerals. Let me make this simple. The world doesn't just fight over what's in the ground. It fights over who controls the process from the ground to the finished product. Mining is hard. Processing is harder. And the reality is the bottleneck in many resource chains is not the existence of minerals. It's the refining capacity, the supply chain reliability, and the political control over those choke points. So yes, Greenland has resources, but the immediate value isn't we mine tomorrow and get rich. The immediate value is leverage, future optionality, strategic denial to rivals, and the ability to build a long-term position in a region that becomes more valuable each year. And that brings us to the real market question. Why did gold and silver react so aggressively? Because the market doesn't need certainty. The market needs probability. And right now, probability is shifting toward a world with more tariffs, more fragmentation, more defense spending, and more distrust between allies. That is a world where the dollar can stay dominant while still losing purchasing power. That's the part people struggle with. They think the dollar either collapses or wins. Reality is messier. You can have a dominant currency that still weakens over time because supply grows faster than trust. Now, the tariff timeline matters. A threat that starts at 10% and rises to 25% is not just a headline. It's a schedule. It's a countdown clock. And countdown clocks are rocket fuel for volatility because they force decisions. Companies move supply chains. Countries retaliate. Funds rebalance. Traders hedge. And through all of that, the metals often act like the emergency exit sign on the wall. They don't always save you, but they tell you where the fear is. Now, here's a cliffhanger that matters for your portfolio. What if this isn't just about Greenland? What if Greenland is the visible symbol of a broader hemispheric consolidation strategy? Because once you accept that framework, a bunch of other moves start to make sense. Infrastructure deals, base expansions, pressure on choke points, control of ports, influence campaigns, sanctions, tariffs, all parts of the same chess game. And in that game, the investor's job is not to cheer. The investor's job is to position. So, let's talk Davos. Davos is where elites pretend everything is stable, while quietly preparing for instability. It's where leaders talk about cooperation while calculating leverage. And if the US president arrives with a confrontational posture, you can expect three things. 1. Public outrage. 2. Private negotiation. 3. Market overreaction. That third one is where opportunity and danger live. Because markets hate uncertainty, but markets also love clarity. If Davos produces a deal, a compromise, or even a framework, you could see a relief rally in risk assets and a pause in the metal surge. But if Davos produces a blowup, a public split, or escalating threats, the metals bid can intensify, and so can the stress in stocks and bonds. So, what should you watch? Watch the dollar. A weakening dollar alongside rising gold isn't shocking. That's classic. But if you start to see the dollar weaken while risk assets also weaken, that's the tighten your seatbelt environment. That's when global money is searching for shelter. Watch treasuries. If yields rise because treasuries sell off, that's not just rates. That's a referendum on confidence, fiscal paths, and political stability. And watch silver. Silver is the loud cousin of gold. When silver runs, it often reflects speculation, scarcity narratives, and risk on fear at the same time. It can be explosive. Now, quick creative break, because I promised I'd do this smoothly. If you're into silver-related success stories, people who built real wealth and turned simple decisions into serious outcomes, there's a link in the description to another channel you'll enjoy. Subscribe there too, and binge a few stories. It's one of the best ways to stay motivated while you're building your own strategy. All right, back to the main plot, because there's a bigger question hiding behind all of this. Is the world accelerating toward a multipolar order where the rules become regional, alliances become conditional, and money becomes more defensive? If yes, then gold and silver aren't just trades. They become indicators of how fast the transition is moving. Now, let me give you a framework that keeps you from getting whiplash. In a stable world, stocks up, bonds up, dollar stable, gold sideways. In a stressed world, stocks down, bonds down, dollar down, gold up, we're flirting with a stressed world pattern. And when that pattern appears, it's not always permanent, but it's never meaningless. Now, the script we're transforming referenced a strategy document that basically says the US wants to protect its territory, economy, and way of life from foreign influence. It also emphasizes the Western Hemisphere, staying stable enough to prevent mass migration pressures and to keep rival powers from owning key assets. Translate that into market language, and it sounds like we are willing to use economic and strategic tools to control outcomes closer to home. That's tariffs, that's bases, that's pressure on ports, that's energy leverage, that's supply chain control. Now, let's talk about energy for a second because it's not optional. When you control energy flows, you control inflation expectations. When you control inflation expectations, you control politics. And when you control politics, you control central bank decisions. And central bank decisions are one of the biggest hidden drivers of gold. This is why, even if you don't care about Greenland, you should care about what Greenland represents: a willingness to treat geography as leverage again. Now, the original script tied this to a petrodollar discussion, oil traded in dollars, and the leverage that creates. Here's what matters for you. Even if the global system is slowly diversifying away from the dollar can remain the primary transaction unit for longer than people think. But the cost of maintaining that role can be higher deficits, higher defense spending, and more aggressive policy choices. And those costs tend to show up in the purchasing power of fiat currencies. That's why when gold screams higher, it's often less about gold is strong and more about money is getting weaker. Now, we need to address the elephant in the room. Are we heading toward broader conflict? Some people throw around big war timelines like it's a calendar appointment. Reality is that conflict can unfold in layers. Information warfare, economic warfare, cyber warfare, proxy conflicts, and eventually hard military moves. You don't need to predict the final layer to benefit from understanding the earlier ones, because the earlier layers already affect markets. Tariffs are economic warfare. Sanctions are economic warfare. Technology restrictions are economic warfare. Supply chain decoupling is economic warfare. And investors feel it in their portfolios before they feel it in their headlines. So what does this mean for the average person watching this? It means you should stop relying on everything will go back to normal as a strategy. And in periods like this, your edge comes from being early, not loud. Now, I'm going to ask you 2 questions, and I want real answers in the comments because your responses shape what I cover next. Question 1. Do you think the Greenland pressure campaign ends with a deal or with a fracture in alliances? Question 2. If gold is running like this, do you see it as a warning sign or a long-term repricing of what money is worth? Drop your take below. Even if you disagree with me, I want to see your reasoning. And remember, if you're successful, whether you made money in metals, stocks, business, or anything else, share one line about your success in the comments. Your story raises the morale of someone who's grinding silently. Now, let's build the timeline and keep the tension, because retention matters. And this story is moving. We have a tariff schedule. We have a global summit. We have markets already pricing risk. We have safe havens accelerating. And we have a broader doctrine that points toward consolidation of influence. What happens next depends on reactions. How do European leaders respond? Do they negotiate? Do they retaliate? Do they publicly oppose while privately compromise? How do markets respond if retaliation hits trade flows? And how do central banks respond if inflation expectations shift again? Because if tariffs rise, prices can rise. If prices rise, central banks hesitate to cut. If central banks hesitate, growth slows. If growth slows, political pressure rises. It's a chain reaction. Now let's talk about the narrative war because this is where most people get tricked. The mainstream conversation will reduce this to one leader causing chaos. That's easy. That sells, but it hides the structural problem. The system has been under stress for years, and now you're seeing the stress become visible. Debt levels, supply chain fragility, demographic pressures, technology rivalry, energy transition costs, regional security competition. Those forces were already pushing the world toward fragmentation. The Greenland story is simply a loud flare in the sky. And when flares go up, markets look for exits. Now I want to slow down and show you the trap that a lot of people fall into in moments like this. They hear tariffs and they think it's just politics. But tariffs are a tax. Taxes change behavior. They don't just change prices, they change who wins and who loses. When a tariff lands, companies have three choices. They absorb the cost and accept lower margins. They pass the cost to customers and accept higher inflation. Or they reroute supply chains and accept disruption. None of those choices is free. And this is why the bond market gets nervous. Because inflation pressure plus disruption plus higher defense spending is a cocktail that makes fiscal math uglier. Now, here's the part nobody wants to say out loud. A lot of modern markets were priced for a world where politics stayed in the background. Cheap money, stable trade, predictable alliances, global supply chains. But when politics moves to the front, the discount rate changes. And when the discount rate changes, valuations can compress fast. That's why you saw the fast move. Stocks down, bonds down, dollar down, metals up. It's the market's way of shouting, we don't know the rules anymore. And when the rules feel unclear, the most valuable asset becomes optionality, being able to adapt. Now let's make this even more practical because I don't want this video to feel like theory. Imagine you're a manufacturer in Europe exporting to the US. You've got contracts priced with thin margins. You've got inventory in transit. You've got customers expecting delivery. A 10% tariff is already painful. A 25% tariff can be business-changing. So what do? You hedge currency risk. You hedge commodity inputs. You renegotiate contracts. You lobby your government. You threaten retaliation. You delay investment. And those actions ripple across markets. That's why geopolitics is not separate from finance. It's the upstream river that feeds the downstream lake. Now, let's bring gold and silver back into focus with one key idea. Metals move not just on fear, but on policy response. If the system sees stress, policymakers respond. If policymakers respond with spending, currency supply rises. If currency supply rises, metals often reprick. So, even people who don't care about missiles or maps should care about the policy feedback loop. Now, I'm going to give you a mini behind-the-curtain moment in the same spirit as this channel. When mainstream narratives get loud, ask yourself who benefits from that narrative. If the narrative is everything is fine, it benefits the system that needs stability. If the narrative is everything is doom, it benefits the traders who want you to panic. If the narrative is don't look at metals, it benefits the people who want you trapped in fiat risk. And here's why I'm saying this. When gold and silver are making records, you will see two kinds of headlines. One kind will tell you it's a bubble and it's about to crash. The other kind will tell you it's unstoppable and you must buy right now. Both extremes are designed to steal your discipline. The smart move is to watch structure, not noise. Now, I want to talk about the structure of this story because the Greenland narrative has multiple endings, and each ending has different market consequences. Ending A, a public fight, a private compromise. This is the most common in Highland negotiations. If that happens, expect choppy volatility, but not full-blown panic. Ending B, escalation and retaliation. This is where tariffs expand, counter-tariffs appear, and the world slides into a trade war chapter. If that happens, inflation pressure rises, growth expectations drop, and hedges like metals stay supported. Ending C, an outright fracture. This is where alliances don't just strain, they reset. If that happens, the market starts pricing a new order, and that process can be violent. Now, if you're wondering why I keep teasing bigger than Greenland, it's because I want you to connect dots. A hemispheric consolidation idea doesn't stop at one island. It is a mindset. Control the near abroad. Control strategic corridors. Secure inputs. Reduce dependence. And in that mindset, you could see moves around ports, canals, minerals, energy routes, and technology choke points. This is why I keep saying, don't anchor on the headline, anchor on the doctrine. Now, let's do a quick viewer question segment because I get these every day and they deserve real answers. One viewer asked, if gold and silver are running, should I wait for a pullback, or is this the start of a new leg? Here's how I think about it. If your plan is to trade short-term, you respect pullbacks because moves can retrace hard. If your plan is to hedge long-term currency risk, you don't obsess over the perfect entry. You build a position with rules. The worst place to be is no plan, because then every candle controls your emotions. Another viewer asked, if silver is close to triple digits, does that mean it's too late? Not necessarily, but it does mean the market is excited. And when a market is excited, you manage risk tighter. It's also why I told you earlier silver can be explosive, but it can also be chaotic. Now, I'm going to add one more question that I want you to answer in the comments because it matters for retention and for future videos. Do you personally think the next big shock comes from tariffs or from bonds? Because if bonds crack, that's when the whole system feels it. Now let's talk bonds in plain language. Bonds are promises. A treasury bond is a promise backed by a government's ability to tax and print. If investors start demanding higher yield, they're demanding more compensation for risk. Sometimes that risk is inflation, sometimes it's deficits, sometimes it's political instability, sometimes it's all three. And if yields rise too fast, it becomes a pressure point for the entire economy. Mortgages get expensive, business loans get expensive, governments face higher interest costs, growth slows. And when growth slows, politicians want stimulus. And stimulus tends to be metal-friendly. This is why I keep watching the bond market even more than the stock market in moments like this. Now let's bring in another angle. Central banks. Even if you never read a central bank report, you should understand the incentive. Central banks want stability, but they also want control. And in a world where geopolitical trust declines, central banks often diversify. That doesn't mean they hate the dollar. It means they want optionality. And that optional behavior is one of the reasons gold demand has stayed so persistent in recent years. Now, I'm not verifying any specific numbers from the original script, but the behavior is what matters. When uncertainty rises, institutions buy insurance. Gold is insurance. Now, here's a subtle signal I want you to watch that most people ignore. Watch how quickly people shift from talking about growth to talking about security. When the conversation shifts, budgets shift. When budgets shift, deficits shift. When deficits shift, currency supply shifts. And when currency supply shifts, metals respond.